Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is trading covered calls and short puts. And today we're going to be exploring a strategy that some traders use when they're selling puts for income. And I refer to it as the 1% rule. That is that each trade should deliver at least the potential for 1% of income. We're going to be seeing how far we can push the probabilities of success on a trade like that. We also need to explore the way that the trade can go south on us. So it should be a really good discussion. We have an example trade coming up, so looking forward to all of that. But first of all, let me say hello to everybody that's joining us here in the chat live stream. Good to see Bob, Rams, Fatima, JB52, Ted, Life in the Fast Lane, Sharon, Ricebird, Eva, and everybody else. We always do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Monday webcast series, and it kicks off promptly at 2 Eastern. We'd love to have you here. I also want to let you know that my very good friend Mike Fairborn is hanging out in the chats. He's going to be addressing any questions that I can't get to. Everybody, if you were here just earlier today, you saw Mike do a great job in another webcast. We know what a great presenter Mike is and the wealth of knowledge that he brings. So thanks for having my back there, Mike. And Mike and I would like to issue an invitation to everybody watching, whether on the live stream or on the archive. If you're not doing so, please do follow us on X. It's the best place to connect with your favorite presenters in between the live streams. You can find Mike on X at Mike Fairborn CS. You can find me there at Cameron May CS. All right, but let's get into this. And of course, we always kick things off with a quick review of the risks associated with investing. These disclosures are important, so bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So with that accomplished, I do want to set a quick agenda for the day. First thing I want to do is just take a quick peek at last week's trade and see what's going on with the markets. Then I want to talk about this 1% rule that some traders employ when they're selling options for income. And explicitly, we're going to be selling puts for income today. So we're going to be looking at an example trade. We're going to be looking to implement that 1% rule. And I'm going to talk about maybe a way that we can go ahead and screw up those probabilities. Yeah, there's actually something that can unintentionally be introduced to the equation that can really kind of blow up the probability of success on a highly probable trade. But before we're done, I also want to make sure that we place an example trade. So let's go right to the markets. Actually, we're going to start off with a review of last week's trade on Thinkorswim desktop software platform. If you are watching us for the first time, the software that I'm using to demonstrate in today's presentation is known as Thinkorswim. It can be downloaded free of charge, doesn't cost anything. Download it from inside your Schwab online account. Just go to the Trade tab and you'll see it right there. Again, called Thinkorswim. But last week's trade, we got into, we have some exposure now in the financial sector. With Citigroup, we took an initial position of 100 shares on Citigroup and sold a call against that position that now has 39 days till expiration. So we bought the shares at 73.05. We'd like those shares to go up in value. Now they've kind of waffled and gone down a little bit, down to $72 from 73. So down about $1 on the shares. On the contracts, we collected $1.03. With that, we'd like to see that wither away to zero, and it's kind of working in that direction. It's down to 70 cents. So up an unrealized gain of 33 cents on the call, down an unrealized loss of about $1 on the stock position. So overall, yeah, down 72 bucks. Let's go have a look at the chart of Citigroup and see if anything substantial seems to have changed, at least in the trader's opinion, as they hold this position. So what we saw last week was a pretty solid support, apparently, around that 67.5 level. A stock has sort of squeezed out or pinched out into what we'd call a symmetrical triangle. Not everybody does this sort of slightly more advanced approach to chart trading. Some people might just look at the chart and say, if it's going up, I got a white candle today, good enough, let's buy the stock, let's sell a call. But in any case, we entered our position right there. You can see that white candle from a week ago. We popped up a little bit, we've sagged off a little bit, and now we're sort of in recovery mode, at least at this stage in trading here on Monday. So we'll see if this continues to cover, but just down a little bit on the stock, up a little bit on the option. Net, it's not quite a wash, a little bit underwater, but trade seems to be doing just fine. We're going to let that continue to work toward its expiration. But I also want to go have a look at the markets, and what we're going to be doing today is looking at adding a new position, and I think we're going to plan this for the February 21st expiration. That's out here indicated by this dashed line. So if we're going to bring in a new position structured around income, maybe what we ought to do is just go see what the markets look like for stock traders and also for options traders, because we're going to be doing one based on the performance of the other. So let's go have a look at the S&P 500, and it's getting a little bit sketchy out there. What do you think, guys? For our technical trader, as we look at what's been happening here, I posted on X just a few hours ago about this behavior in price activity on the S&P 500. What does this look like? Starting back here, the first week of November, carrying us through to the first week of January, this 2 months. What might this be? Well, for some traders who see that the S&P has been coming up, when we hit a high, followed by a subsequent high, followed by a third high, where we were seeing higher highs previously, but now lower highs, it might be an indication that the trend is under technical threat. And we can refer to this as a head and shoulders pattern, right, Ted? 9x Tim, exactly, yeah. So for some traders, if we break down through what's called the neckline of that pattern, so if we look at this, this is one shoulder, so left shoulder, right shoulder, head. If we break down through what's sometimes called the neckline, for some traders, they see that as a possible signal that the trend not is changing, but has changed. Yeah, there might be some out there who are saying, boy, this is set to go down, and it might. We'll see. We'll see. If they hold those convictions, another common thing that they might do is measure the distance from the neckline here. Looks like that's about 58.50 up to the high up here about 61. So what's that, about a 250-point swing upward? Well, a break of that line might for them project a 250-point swing downward. That might bring us down here to about 5,600. Obviously, that's a tale yet to be told. We'll see. But for others, they might look at this head and shoulders, which is a comparatively shorter term bit of technical data, and they have to balance that. They might weigh that against what the trend itself has been doing for so long. It's been years with this upward trend, with relatively minor departures from it from time to time that tend to be kind of short term. Those traders might say, yeah, all right, it hasn't been a great move over the last month, but that's kind of taken us right down to a 100 period moving average. And as a matter of fact, we're sitting right at that 100 period moving average as we speak. We're also right on top of a trend line, and they might see this as possibly the worst time to start getting bearish. So who's right? Who's right? The head and shoulders traders who think that, hey, we broke the neckline, we're headed down. Or the trend traders who say, hold on, the trend looks like it might still be intact. We're sitting right at the trend lines. We might be swinging up. Time is going to tell. The markets are going to do what they're going to do. But for today, let's put ourselves in the shoes of a trader who holds the conviction that the head and shoulders in the face of the strength of that longer term trend might falter. Maybe they expect prices to rise from here. And so they might see this as still a decent opportunity for entering into a bullish strategy, such as a covered call or a short put. Both of those are bullish strategies. Today, we're going to be doing a short put. Okay. But before we go do that, we have this backdrop of what's going on with the stock market. What's going on with the options market? If I were to throw this question out to my audience right now, those of you who feel relatively comfortable with volatility indices like the VIX, might today be described as a buyer's market for options or a seller's market for options? What do you think? Dave says, what has changed fundamentally? Dave, things are changing all the time. I think that with recent really strong economic news, last week we had, for example, a jobs report that came in with a stronger than expected job creation, which means the economy might be healthy. That sounds okay. Except at the same time, on the same day, we received news that that the projected inflation rate for the year also was increased from 2.8% to 3.3%. So stronger concerns of inflation might mean that the Fed needs to take some action, which is sort of what was on the docket already for this year. Except if they do that, it might light a fire under the economy if they cut rates and send the economy soaring even faster and possibly lead to worse inflation. So yeah, they might be kind of pinched in a corner. We'll see. Yeah, but things change all the time, right? New information's coming out tomorrow. So let's go have a look at, thank you, Eva. Yeah. Eva, I know you say that tongue in cheek, but there is a survey. Let me do this. Let's hit the pause button right here before I move over to the volatility index and direct our attention to what Eva is correctly pointing out. There is a survey here for the attendees in the live stream. So if everyone here would do me this favor, click on that survey link right now, and then you can give me some honest feedback when the webcast is over. I just want to tell you, if you've never filled out one of our surveys before, they're really quick. 2 multiple choice questions. It could just be click, click, and you're done. Or if you want to take the extra time and fill out the comments box and the suggestion box, I also read through all of that. Just know that if you take the time to fill out my survey for me, that information gets sent directly to me, and it always helps. It's never a wasted effort. Okay, I'll read through that. Thank you. But now let's get back here to the volatility index of the S&P 500, which for some traders they use as a general gauge of the options market. So with the S&P, that might be used as a gauge for the stock market. The VIX might be used as a gauge for the options market, and generally speaking, when the VIX is high, that tends to correlate strongly with most options premiums being high. When the VIX is low, that tends to correlate strongly with most options premiums being low. So if premiums are low, prices are low, traders might see that as more of a buyer's market for options. If premiums are high, they might see that as more of a seller's market. And it might look like, well, geez, we've been way up here, Cameron, and we're way down here, so that clearly this is a buyer's market. Well, it's not just the extremes, but also the percent of time that we're spending above current levels. So here's current level, and you can see really there have only been a few spikes all year long above today's levels in volatility. So even though, in contrast with the absolute extremes from August that we saw here, we might still say options premiums comparatively elevated in contrast to where they've been much of the last year. We've spent more time lower than we are right now, so we might say that options prices are higher than normal, and they may start going down. Just because they're high doesn't mean they can't go higher. We've seen examples of those. They tend to be short-lived examples. But yeah, for those of you who said this is more of a seller's market, I would tend to agree. It looks like more of a seller's market of options. So if we're bullish on the stock market and it's kind of a seller's market for options, that could be lining up nicely for a trader who might be considering doing something like selling a put, which is a bullish selling strategy. So let's go do that. And I'm going to use an example stock here today. Stock is going to be NVIDIA. So here's NVIDIA. Why did we select NVIDIA? Well, there are a number of, I discussed this last week, but a number of potential pre-qualifiers when traders choose a specific stock on which they intend to do options strategies. One of those pre-qualifiers may be the price of the stock. Higher price stocks tend to offer more options to choose from, but of course, when selling those options, they come with a stronger obligation, a more expensive obligation, so there's a bit of a trade-off there. Number two is traders commonly emphasize the liquidity of the stock. Illiquid stocks tend to have quite illiquid options, and it can cause difficulties in the pricing of those contracts, making it making it more difficult to get into and get out of those contracts efficiently. It can just make them harder to trade profitably. So highly liquid stocks, maybe on the higher end of price, high double digits into the triple digits might be the preference of some. That's going to vary from one to the next. Now, there could be additional qualifiers. Maybe the trader looks at the fundamentals of the company. They're looking for maybe growth metrics or indications of value. I'll leave that up to the individual investor to decide. But in addition to that, maybe exposure to different sectors. We're already in this example paper money portfolio. Our first trade of 2025 was in the financial sector. This, NVIDIA, is in the technology sector. So maybe a little bit of diversification on offer here. Maybe the trader can spread their risk out a bit, at least conceptually. Now, final consideration is the trend on the chart, or just the chart itself. Does the chart appear to be bullish for this bullish strategy? And when we look at NVIDIA, you can see it had a good run starting more than a year ago. Now, over the last, let's look at this over the last 7 months, there's been more choppiness to it. Generally accomplishing higher highs, but taking more effort to do so. And as a matter of fact, in the last week, we hit the 12-month high, but then sold off from that. Now look where that's positioned us, much like the S&P 500 that has taken it's taken NVIDIA shares right down close to that 100-period moving average. That's just a simple moving average. If you're not familiar with a simple moving average, it's just sort of average prices over time on the stock chart according to closing values of the last 100 days. So when we have a simple moving average value of 132.29, that tells me that the average closing price over the last 100 days, let's see, I'm sort of eyeball circling 100 days, something like that. It probably goes back a little bit further because 100 days is about 6 months of trading on a chart. So it's about this time frame. The average closing value of NVIDIA over the last 90 days has been about $132.29. And that average has been working its way upward. And for some traders, they might see this as maybe a clearer picture of the trend when the trend isn't just obvious from the price activity on the chart. And you can see a lot of choppiness on this chart. But another thing that average might serve to do is for some traders, they look at that as potential price floors and price ceilings. It looks like we're trading right at that. Maybe that'll be a new price floor if we can get another day of strengthening prices on NVIDIA. But we have the moving average. We also have the trend line itself, just like on the S&P 500. Our stock looks like it's come down to and touched that trend line. And also, we might be sitting right at an important area of price floors and price ceilings right around that 128.5 level. So sort of a convergence of technical evidence between that simple moving average, the trend line, and the support. We're sitting right in there. So our trader might look at this, take it all in total, and decide, well, this looks like it might head higher. Maybe I'm going to get into an income strategy based on the assumption that this is likely to go higher. And in our trade, we're going to put on a position that brings in some income not realized until an expiration out here on the 21st of February. That's what we're going to do. Frankie says, which factors you consider in determining whether to sell a put or a covered call? Frankie, I need to do a good webcast on that where I explore I was going to say the differences. They're actually very limited differences between a short put and a covered call. In reality, they are almost identical strategies. So if I'm sitting in a classroom full of new traders and I'm teaching them the concepts of trading, and we're all looking at the same chart. Half the classroom decides to do an example short put, and the other half of the classroom decides to do an example covered call. I would say sounds good to both because they're such overlapping strategies. So, yep, that's sort of the short answer to that, but I definitely need to give it a longer examination in a future webcast. That's coming down the line. I've done it in the past, just not for this webcast series. So let's go build an example trade scenario here for NVIDIA. So let's go to the Trade tab. I said we're looking at the 21st of February. Well, let's go up to the actual 21st of February as I accidentally circle the 21st of March. Yeah, let's go to the 21st of February and open that up. And I wanted to talk today about this concept known as the 1% rule. And this is for traders. And how many of you heard this? I've seen it chatted in dozens and dozens and dozens of times. But how many of you have heard traders say, well, I need to get at least 1% income from the option that I'm selling? 1% of what? Well, it's 1% of the obligation of the contract. So here's a quick way to zero in on what I'm talking about. Quick way to do that is to look at the lowest strike price on a put that offers an ask price of 1% of that strike price. So if I were to go, let's go to the at the money contracts. Stock's trading right around 132. If I were to look at 132, you can see the 132 contracts have about a 745 ask price. That's actually, what, about 4 or 5 times? In other words, it's about a 5% potential return. If we were to sell that, it looks like we might be getting about $7.40-ish. But in exchange, someone has the right to sell shares for us to 132. So if I were to do the math on that, if we collected a premium of 740, divided that by an obligation to maybe have to buy the shares at 132, that's about a 5.6% income from the put, but we're obligated to buy the shares for just about what they're trading for right now. Let's contrast that. If we were to zip up here, whoop, all the way up this option chain, and I look at, let's say, that 109 put, that has an ask of about 112. So the bid is about a 111. Let's say we're able to get a $1.12. So 111 to 113 is the current bid ask spread. Looks like it shifted on me again. We'll call it 111. Let's say we collect 111 in premium on that. With an obligation, an associated obligation, when we sell a put, what we're doing is accepting a payment conceptually from some other trader out there in the options trading universe, and in exchange, they have the right to sell us. It's a contractually enforced right to sell us shares for the strike price. So in this case, that would be $109. So if we're getting paid $1.11, $1.11, and in exchange we have the obligation to buy shares for $109, well, what percent is that? That's right at 1%. So the no DAX says I try to use the 1% rule. Yeah, and this is, believe me, this is not intended to be a promotion of this approach, because there are pros and cons to doing the income trading this way. But yeah, why might some traders say 1%? What I've just shown you is a quick way to identify 1% as the minimum. You can see if we were to go lower than that, we might be getting only $1 on a 108 obligation. We're starting to slip below 1%. $1 is not 1% of 108. I'd need 108 to be 1% of 108. But why do some traders insist on at least 1%? Well, it may just be diminishing returns there. We're taking upon ourselves an obligation that carries with it risk. And hopefully there's some compensation for that risk. And included in that is we even have to pay commissions out of that premium, and that gets chipped away. So let's say just to exaggerate things, we get into an options trade, a contract where we only collect 1 penny, regardless of the obligation. We only collect 1 penny. Is it worth doing that trade? Maybe to some, but sitting around for 39 days with a great big obligation sitting over our heads to collect 1 penny might not be enough. So 1%, I think, for some can just be sort of a convenient cutoff level as a minimum. There's nothing, sacrosanct about that, but that's where we're going to set our target for today, looking for at least 1%. Looks like we're sitting right there. So I think what we're going to zero in on for today's example trade is going to be that 109 strike. So let's map it out. So our example trade today is a short put. And we're going to sell the 21st of February 109 put for, and we're just at, oh, look at that. It was right at about 109. Okay. Ted says 1% before or after commissions. All right, well, Ted, that's going to play a bit of a role. If we collect $1.09 here, and we just do one contract, there's going to be a 65-cent commission. So what that would do is it would change it to $1.08. Well, no, it would be, instead of getting 109 net, if we're able to fill at 109, we might get 108 and 35 cents. We'd still be right. We'd be at that 1% threshold. So before or after, it's up to the trader's preference, I suppose. It's still a consideration. It's just not nearly the consideration it once was. How many of you have been trading for 20 or 25 years and you remember those great big commissions that we used to have to pay back in the day? Yeah. Anyway, yeah, it's still a consideration. Commissions are still a thing, but just not much of a thing anymore. Anyway, so back to our trade. I do want to emphasize, if this is your first time ever doing a put, let's help to visualize this on a chart. I'm going to draw in a line down here. So here's today's candle. Let's go down below today's candle and draw in a line at 109. Right about there. We're going to carry it out to expiration and talk about, once again, what in the world we're getting ourselves into. Rob, you remember it was pretty bad back in the day? Yeah, I remember it was something that the trader had to consider much more heavily than they do today. But this line represents our obligation. So here we are getting in today. We're trading up at the top of this candle. But through the 21st of February, someone else has the right to sell us shares for $109 per share. In exchange for that, they paid us $1.09. So what is a trader hoping for from this point through the 21st of February? If we're placing this trade, what do we hope happens? Well, we'd like to see price go up, or at least not go down too dramatically. If price goes up and someone else has the right to sell shares to us for 109, could they do it? Conceptually, yeah, they could do it. It's just not very likely. This is already a pretty distantly out of the money contract. Selling shares, I mean, you can twist my arm, make me buy shares for 109. They're worth 132. Thank you for the $23 discount. You can see why that's not very likely. Still possible. Yeah, we'd just like to stay above that 109. Even if the price falls, if we come down here to 115 or 110 or 109.01, if someone has the right to sell us shares for 109, but they can get a higher price for those shares elsewhere outside of these contractual terms, they're probably going to do that. And in that case, if we get to the 21st of February, hey, deal's over. We keep our 109, we're off the hook, and we're on to the next trade. That now becomes a realized gain of 1% on the amount of money that we had tied up in the trade. We had a $109 obligation. That's going to be tied up in a cash-secured trade, and that would be a realized gain. So that's fun to talk about. Let me just clear this. Take this drawing off. Take this drawing off. It's fun to talk about the trades that work out. How could this trade not go so well despite, oh, by the way, before we get to the trade not working out, what are the probabilities that we're actually going to make our 1% return? If we just put this trade on, we don't tinker with it, we just let it run its course toward expiration, what's the probability of success on this trade? As you eyeball this, you're probably already thinking, well, 50-50 could go up, could go down, so it's already 50% that we're going to wind up higher. Even if it goes down, there's not a strong probability that it goes down far enough to go down below 109. This thing doesn't have really any work to do aside from just avoiding collapsing, and we're in position to make that 1% return. Yeah, as a matter of fact, the probabilities of this trade are very high. If you look at the delta on a put, if you look at the delta on a put or a call, it's an indication of the likelihood that an option expires in the money. And for this option, there's a 10% chance that this is going to expire in the money. There is a 90% chance that it's just going to expire out of the money, getting us off the hook, and we realize our gain. So that is could we call that a high probability trade? It is a high probability trade. Yep. That's why for some traders, they like to push for these, at least the 1%. They like to push as far as they can go with those probabilities, dialing those probabilities up higher and higher and higher, as long as they can still get that 1%. And that's where they find the balance for reward and probability. So that's, and some of you probably looked at probability in the money and it could be off by a few percentage points. Yep. These are all estimates of what might happen over the next 39 days. You'll say, well, Cameron, so which one is right? They're both estimates of something that hasn't happened yet. So whether it's 10% or whether it's 14%, we're in that general range of very high probability of success on this trade. I do want to look at another probability, though, before we get done. But even though probability is high probability does not equate to guarantee. Nope. NVIDIA could just decide we're going to do another one of these and continue to collapse before the 21st of February. And if this shoots downward, now we have a different set of facts to deal with. Let's say the stock collapses down to $100. Is the trader going to make money on this put? Nope. Is it a calamitous outcome, though? Not necessarily. Let's say the stock is down here at $100 and someone else has the right to sell less shares for 109. Are they going to do it? Yeah, they're going to do it, especially at expiration. Almost certainly the contract is going to get assigned. We have to overpay for the shares at 109. They're only worth $100, and we're sitting there saying, ouch, we're licking our wounds. We now own a stock. We had to pay 109 for it. It's only worth $100. We're underwater on the stock by $9, but we did get $1 premium up front. So really, the trade is only underwater about $8, and the trader might actually feel okay about that. They might tell themselves, well, that's okay as long as NVIDIA turns around, maybe it bumps off these lows and starts heading higher again. And what they do know for certain is that they bought that at a lower price than if they just bought the stock outright and maybe started selling calls on it up here. You know, they might have bought the stock at 132 and then they're sitting on it only worth 100 shares, down $32 instead of down just 8. But yeah, the downside of this is if the stock collapses and really falls below our strike, the trader still needs to be comfortable. They could be assigned those shares, might have to buy those shares at 109. And the higher when we get below 109, that's when the probability of assignment really starts to ratchet up. Dave, I'm not quite sure I follow your question. John says, what about options volume on a trade so far out of the money? Good question, John. Yeah. Volume is one of those metrics where the trader is trying to gauge liquidity, and I would suspect there might not be a lot of volume on these contracts. However, another gauge of liquidity is just the spread between the bid price and the ask price. When we have illiquid options, the spread between the bid price and the ask price tends to get quite wide. If it's narrow, that means that there's probably a good probability that we can get into and out of these relatively efficiently. It's never a guarantee. But yeah, look at that. It's just a penny on these. 109, the premium received. Yeah, this is the premium over here. Well, it just coincidentally in this case, and right now that premium has shrunk a bit. But yeah, it worked out that we were looking at about a 109 premium on a 109 strike. We might actually have to push up to the 110 and do this one instead, because as I've been talking, guess what NVIDIA has been doing, making the puts worth less. It's been going up in the direction that we were hoping it would. It's just that we've been yabbering about it for 35 minutes. All right. So let me just make sure that we are aware of the fact that what's the ultimate risk when one is selling puts? How much is what's the worst case scenario? Chad says the maximum loss is $10,796. Yeah, how much can the trader lose if they're obligated to buy shares for 109? If those shares fall all the way down to a penny, and we're required to buy the shares at 109, ouch. Can we say ouch? That means we have about $1.08, about $108 of risk. Now, what's the likelihood that NVIDIA actually drops to a penny per share in the next 39 days or whatever it is? I think it is 39 days. Very, very, very remote. It's still within the realm of possibility. It's just highly unlikely. The much greater probability, to the tune of close to 90%, is that we just collect the 1%, the contract expires worthless, and the trader's good to go on to the next one. Eva, yeah, I said yabbering. All right, so I'm going to put this on here, 90%-ish probability on this trade. But when I kicked off this discussion, I mentioned there's a way that this can get all screwed up. There is a way that the trader can change this from a 90% probability to a much lower probability trade and not get an offsetting increase in the reward potential on the trade. And that is if we tinker with it. What does tinkering mean? Well, let's suppose that our trader is getting in, selling this put, and they think it's going to go higher. They think the stock is going to go higher and the put will be in good position to expire worthless. But they also think, well, yeah, but if it starts to break this support, maybe if it gets down to 125 or if it gets down to 120, I'm just going to get rid of this put. I'm going to buy out of it. I'm going to take whatever lumps I have and put in a stop. Let's just envision the trader says, all right, well, if we break this support, I'm going to have a stop waiting down here to stem the bleeding for me at 125. Just going to get out there. What did we just do with the probabilities of this trade? Well, the initial assumption of the trade was if we put the trade on, as long as it's above 109, we're in position for maximum theoretical gain at expiration. What we've added here is a new assumption. If this stock even slips down to 125 at any point between now, and actually I should extend this line out, should have started it out here. Let's just put it a little bit more there. If this stock dips down and touches 125, I'm out, probably with a loss. What we've just done here is flipped the likelihood of probability, or the likelihood of success to a likelihood of failure on the trade. Maybe not, but we've increased the probability of that happening. We can look at that. If we just go back to our trade tab, it's probably not actually more than 50%, but if we look at the 125 puts and we look at the delta, there's a 31% chance, actually, nope, sorry, nope, back button, nope, I got ahead of myself, ignore the delta, it's not what I wanted to talk about. Let me come up here and we're going to add a custom column here. We're going to select customize column sets. I've already added it, but what we look for is something called the probability of touching. Add that to our chart and click OK. So that's this column that you see right here, the probability of touching. What is the probability sometime between now and February 21st, when this contract is set to expire, that the stock just dips at least once down and touches 125? There is a 71% chance that that happens. And what was the plan at that point with a stop in place? It was to pull the plug on the trade. So there's a 71% chance that exactly that is going to transpire, and the trade ends most likely unprofitably. So we just flipped this very high probability trade, high probability of success, into a high probability of failure as the trader is attempting. Obviously, the motivation here is to mitigate the risk. But I just wanted to just wanted to call that out. Using stops on trades that require some patience frequently can really mess with the probabilities of success on the trade. So with this trade, we are not going to put a stop in there. Let's just remove this drawing. Let's remove that one. And we're going to hang in there. If the stock is still above 109 at expiration, if we're not assigned, and in paper money, we never get assigned. That's not true in real life. Even an out-of-the-money contract can get assigned, but there's no such thing as early assignment in paper money. So what we're shooting for is to just get to expiration, come what may with price activity, exposing ourselves to the downside risk here. If the stock collapses, we may wind up having to buy the shares at 109 when they're not worth that much. Okay, let's go do our trade. How do we do the trade? We just go to our intended strike. It looks like this has shrunk down just below 1%. Instead of the 109, I'm going to go for the 110 now. So what that's going to mean is that we have just not quite as much wiggle room here. Let's push this up to 110. Oh, 110. Oh my goodness. 110. Let's go to trade. Click on that 110 bid price. Selling, I'm just going to do the one contract here of the 110 puts. Looks like that might bring in somewhere $1.14, $1.15. That's okay. We'll leave it right there. Submit that as a limit order, day order. Let's click confirm and send. Selling the NVIDIA, 21st of February, 110 put, trying to get $1.14 out of it. That's going to tie up about $11,000 on this trade with a $114 potential profit. That's right over 1%. There's that commission. So it just chips that away by 65 cents. Brings us down to 113.35 if we can collect that premium. Let's send that off and see if we can get a fill here. Let's go to our trade tab. Let's see our working orders. Asking 114. You can see our mark has fallen to 113. Stock is being very nice. It keeps going up, which is what we're hoping. I'm going to do this. Right click, cancel and replace that order. I want to get this filled. There's a narrow spread between the bid and the ask price. That doesn't mean I can't still get a poor fill here, but I'm going to put this in a market order. Click confirm and send, replacing the original with a market order. We might not be thrilled with the price that we receive, but we'll see. Let's send that order off. There's still that commission. And that should fill pretty quickly. I'm going to let that, yep, sold it at 114. Good enough. That's what we were shooting for anyway. Did it? No, at 112. Okay. But everybody, we've accomplished what I set out to do today. Harlot says, can we do this with an IRA account? Yes, it is a legal trade to do in an IRA. Traders still have to fill out an options application, but it will require a full cash, has to be fully cash secured for the obligation on the trade. Basically $11,000 trade, so basically $11,000 would be required in the IRA, untethered to any other trade, in order to do this sort of a trade. Okay, so yeah, permissions have to be granted first, but yeah, it is a trade that's possible in a retirement account, in an IRA. All right, but everybody, we've accomplished what I set out to do today. I wanted to talk about this 1% rule thing. I wanted to talk about how, yeah, high probability of success. There is a trade-off, though, because the trader is typically getting a smaller premium than is available at other strikes. We saw, well, we can get $7 at 132. We can only get $1 at that 109, but the probability is much higher. Using stops on these sorts of trades really changes the probability scenario. So we don't want to fool ourselves into thinking that we're stepping into high probability when our plan doesn't allow for those sorts of probabilities to play out. Mike says, where would the commission fee be pulled from in an IRA trade? Just comes out of your cash and trade proceeds, Mike. Yep. But we're going to follow up on this trade in future webcasts. We'll also follow up on that Citigroup position, see if it continues to do okay. We'll continue doing more covered calls and more short puts and learning along the way. But I want to make you aware of other resources that you have outside of this discussion. Number one is if you're not following Mike and me on X, please do that. You can find Mike on X at Mike Fairborn CS. You can find me there at Cameron May CS. It's the best place to connect with your favorite presenters in between the live streams. I'm posting on X when I'm, if I'm not on a live stream, which is most of my time, that's the best place to connect with me. But also make sure that you're subscribed to our Trader Talks channel. If you're enjoying these webcasts, go down below the window right now and click on the subscribe button, because the YouTube channel, our Trader Talks channel, is where we post our playlists of our previously delivered webcasts. They're organized by series. You can also join the live streams right here, or if you have a topic of specific interest, you can do a quick search. So a great resource there. Hey, Mike, thanks for helping out in chats. Everybody, this is your opportunity now. If you would go fill out that survey, give me some honest feedback. It's always appreciated, and I will definitely read through that information. I also want to thank you. Over 200 people watching this live stream. We have 60 that have already clicked the like button. That's fabulous. I appreciate, to me, what's an electronic pat on the back. If you do me the favor, anytime you enjoy one of our webcasts, make sure that you're clicking that like button. All of this only takes a second. Clicking the subscribe button only takes a second, doesn't cost anything. Following on X only takes a second, doesn't cost anything. Clicking the like button only takes a second, doesn't cost anything, but it all helps. And liking my webcast gives me a pat on the back. It also gives my webcast a boost in the YouTube algorithm. But everybody, thanks for giving me your time today. I'm going to let you go. I will look for you again next Monday. I'll look for one of my other webcast series throughout the week. I'll also look for an X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.